Welcome to Taking Stock for the week ending the 6th of March, 2026. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to your Think Share Market. Welcome back, Jace.
Thanks, Kien. Thanks for having me. It's always a pleasure to be here.
Great to have you on board, especially with reporting season done and dusted now. But before we begin, just a quick yet important reminder, the information we provide is of a generic nature and shouldn't be taken as personal advice. Shares are volatile, so past performance figures aren't a reliable indicator of future returns. Also, with Stock Doctor being part of the Prime Financial Group, if you require assistance with other services like self-managed super funds, accounting, or diversifying your investments into property alternatives, please reach out to one of our customer service teams. Well, Jace, global markets have pulled back slightly this week again as tensions in the Middle East escalated, and this has pushed volatility higher, with investors moving to safe haven assets such as gold and the US dollar. But also oil prices rose on concerns the conflict could disrupt global energy supply and lead to higher inflation.
Yeah, that's right, Ken. And the volatility has obviously arrived just after reporting season comes to an end here in Australia. I mean, overall, the season has been stronger than expected. Earnings forecasts for FY26 has been revised higher by around 1%, and profits are now expected to grow by roughly 10% this financial year. So pretty positive all round. But the strength has been obviously concentrated in a number of sectors, and you've mentioned before gold, and that was a pretty stellar one.
Yeah, that's right, Jason. Bank and mining companies delivered most of the upgrades, while other sectors such as healthcare, technology, and also consumer retail businesses, they face more challenging conditions. But let's now turn to some of our star stock highlights this week, starting with Monadelphous. Now, this is a mining and energy services contractor, quite a highly cyclical business. But Jace, why have we initiated Monadelphous as a star income stock rather than a star growth stock?
Well, Monadelphous is a name that many members are pretty familiar with, especially during the mining boom. The key reasons really came down to profitability and cyclicality, Kien. The company delivers a very strong first half result. Revenue was up 46% and profit increased around 50% or so. And that growth was driven by elevated maintenance activity across the iron ore and energy sectors, as well as a ramp up in obviously energy construction projects as well, which benefited them. The business has very slim margins, and this is something that members should be a little bit cognizant of. Net profit margins were only around 4%, which means it has very little margin of safety and therefore fails our growth criteria under Golden Rule 2. Mining services businesses operate on very slim margins, and because of the pretty competitive tender environment that they compete in, and earnings are heavily dependent on capital spending. So this is characteristic of a lot of companies in this space.
Yeah, definitely, Jason. What makes Monadelphous attractive today, though, is that strong cash generation during the current resources cycle, where resources are booming and they are spending, which supports the dividends. The company lifted their interim dividend by around 48% to 49 cents per share. And with a payout ratio of around 83%, the stock currently offers a fully franked dividend yield of around 3.4%. But because margins are structurally thin and earnings depend heavily on the resource investment cycle, the business is better suited to income investors seeking yield during this favorable period rather than a long-term structural growth story. Let's move on to another initiation we had during the week, and that was with QBE as a star income stock, Jace.
Yeah, the company delivered a result that was ahead of expectations, and this was largely due to a lower catastrophic claims events than what management was forecasting. Meanwhile, gross written premiums increased by around 7%, and this allowed insurance margins to improve. In addition, higher interest rates also supported earnings because the insurer invests their premiums in bonds, which tends to benefit on higher interest rates. As a result, the company delivered a pretty strong final dividend, and this took the full year payout to around 109 cents per share. The stock is currently trading on a dividend yield of just below 5%, which remains still pretty attractive.
Yeah, that dividend was a lot higher than many brokers had estimated. But looking ahead, dividends are expected to ease slightly next year as catastrophe claims normalize. But importantly, The company maintains a conservative payout ratio of around 50% and with strong capital buffers. This supports that dividend sustainability despite the volatility of insurance earnings. And another notable development this week was Sigma Healthcare, which has been upgraded to a star growth stock.
Yeah, the growth story here centers on the merger of Chemist Warehouse, which created a vertically integrated pharmacy business and combined a real wholesale division along with a large retail network as well. The first half results highlighted pretty strong momentum, Kien. Revenue increased around 15% and operating earnings rose by around 20%. And this was driven by strong sales across the Chemist Warehouse network and also ongoing store expansion and improved operating efficiencies following this reverse merger as well. The business currently generates a return on equity of around 24%, and net profit margins are relatively healthy at around 7%. So these criteria comfortably meet our growth thresholds.
Yeah, that margin looks quite decent given that it's a retailer right now. But longer term, growth is expected to come from supply chain integration. You've got private label products and also continued store expansions. However, return on equity is expected to moderate over time as the company invests in expansion and integration. The company now operates more than 550 domestic stores and nearly 100 international locations. And for Under the Microscope this week, let's take a look at Woodside Energy, Australia's largest oil and gas producer, following its merger with BHP's petroleum division. Now, this stock is quite topical at the moment. And Jace, you seem to time this initiation quite well, precisely to coincide with the breakout of the Middle East conflict. It's now a star growth stock and star income stock, and despite strong operational reliability and record production volumes, earnings growth is expected to decline this year, Jace. Why is that?
Well, the key factor, Kien, is commodity pricing. So production volumes have definitely increased, and the average realized oil and gas price, unfortunately, has moderated by around 5% in the latest period. So as a result, underlying net profit fell by around 24% to 2.6 billion US dollars. Woodside's capital expenditure program remains elevated during the current development phase, and this reflects some of the major projects such as Scarborough LNG and also the early development of the Louisiana LNG project. However, spending is approaching peak levels, and this is expected to moderate as Scarborough comes towards its first production pretty shortly. The company still generates pretty attractive returns with return on invested capital of around 8.5%, and this supports its classification as a star growth stock.
Yeah, I guess with all that capex, that's why earnings growth is showing negative this year. But these projects are central to Woodside's long-term strategy. I mean, Scarborough LNG, that's expected to begin production in 2026. And as these developments move from construction into production, capital spending should decline, return on invested capital and free cash flow should increase.
That's right, Ken. So despite the ongoing investment cycle, strong operating cash flow continues to support dividend payments, and the company is targeting a dividend policy of between 50 to 80% of underlying profits, which remains pretty sustainable from our point of view. And also following the recent rally in the share price, the stock is trading at a pretty attractive dividend yield of just under 3%. A lot of members capitalized on some of the capital gains, but they're still rewarded for a little bit of that gross yield.
And now, with the escalating conflict in the Middle East, an interesting question this week is how will this conflict impact equity markets over the course of the year?
Well, Ken, I think that question is on every investor's minds right now, and most of it would probably depend on the duration of this conflict. The current expectation is probably for around a couple of weeks, but if it does extend beyond that, then risk will need to be repriced somewhat. But the larger issue at play right now is obviously energy supply. Iran itself accounts for around 4% of global oil production, and the broader Middle East region produces 1/3 of the global oil supply. So any escalation across this region could really impact energy markets. Another key disruption is of course, shipping routes through the Strait of Hormuz, which caters for roughly around 20% of global oil supply going through that channel every single day. So if there are any disruptions to this route, then that could also compound the rise of energy prices.
That's right, Jason. And higher oil prices, they can have broader implications for the global economy. Energy costs feed directly into transportation, manufacturing, and consumer prices, which means potentially higher inflation and rising interest rates ahead.
Yeah, that's right, Kien. Oil is the lubricant of the global economy. So if there's any spike in terms of oil and gas pricing, then that would have a flow-through effect to most categories of the economy. Historically speaking, if we are talking about volatility, the market tends to experience heightened periods of volatility in the first couple of weeks to even the first 6 months following any geopolitical shocks. You can see on the chart on screen, the average line shows equity pricing, and you can see that in the first 6 months, there is a little bit of a to and fro, but after that, things tend to recover and goes back into positive.
Yeah, very interesting, Jace. But of course, periods of uncertainty can create opportunities for investors to purchase those high quality businesses at attractive prices. But rather than react to headlines, because we really don't know how long this volatility can last, the focus should remain on risk management, remain diversified across at least 15 stocks, and hold financially strong companies that can weather economic cycles. And of course, take advantage of the volatility when you can by purchasing oversold high quality businesses. But that wraps up another episode of Taking Stock. Thanks for your time and insights today, Jace.
It's always a pleasure to be here, Kien.
And if you have any friends or family who you believe could benefit from Stock Doctor, please feel free to refer them. Our community grows thanks to members like you and who value and support the work we do. Until next time, have a happy, healthy, and prosperous week ahead.